Welcome to the FI Investors Podcast, helping you achieve financial independence through real estate investing, one episode at a time. We talk about personal finance, mindset, and real estate investing. Whether you're a rookie or looking to scale your portfolio, we're here to provide you with the tactics and actionable steps to achieve your goals. Here are your hosts, Diego Corzo and Ward Mahoney.
Welcome to the FI Investors Podcast. Today, we have an amazing interview from my good friend Andrew Freed out of the Boston area. His story is amazing because it goes to show how one single property, he had a house hack, he bought a condo, and from that house hack, how it has transitioned now to hundreds of homes, and how he's raised capital, how through his network he's been able to raise capital and put it into multifamily, as he's done syndications, he's done JVs, he has a great business partner that has also helped him scale. So this podcast is all gonna be on scaling, and I am so excited for you guys to learn how he's doing it, and also how you can reach out to him because he currently has a lot of really good deals up in the Boston area. So get ready to learn and take some notes. Now, before we go into the interview, we have some amazing content and calculators and stuff for free 99 on the fiinvestors.com website. So don't forget, go get that free content. And for anybody that is interested in learning more about the FI investors or just want to schedule a strategy call, you can click the button that's right there on the website and you can book a strategy call with myself and the team. So look forward to learning a little bit about you and how we can help. So without further ado, let's talk to Andrew. Welcome, guys, to the FI Investors Podcast. I am here with my good friend, Andrew Freed. Andrew, how are you doing?
I am fantastic. Thank you for having me, Diego.
Yes, very excited to have you here. I know we've had you as a guest for the FI Investors Mastermind a couple of times. One, sharing a bit of your story, how you've been finding deals, all that stuff. But you also came back and you shared on raising private capital and your unfair advantages in that. So really thankful for you to come and share to the mastermind. And now we have the privilege to hear about you and what you're working on here in the podcast. So really excited about that. So with that said, Andrew, tell us a little bit about yourself. I want to hear where you are today, and then we'll work a little bit backwards.
Okay, so where I am today is I currently own and operate with my partner, Zack Gray, about 240 units. We primarily raise money from investors. We take down value add multifamily with the ability to refi a majority of your capital out in year one or year two. And we've built that in the course of just 3.5 years. I only got into real estate about 3.5 years ago when I found Rich Dad Poor Dad. Prior to that, I was doing the normal American dream, project manager, got my master's, got a 6-figure job, got a nice swanky condo in Boston. I did it all, right? I essentially made it. But I came to the realization that quickly I didn't when I looked at my net worth, and I realized it literally took me 10 years to save up $50,000. And a majority of my net worth was in this 1-bedroom condo I bought 5 years ago that I completely forgot about. You know, I read Rich Dad Poor Dad. I saw the power in real estate investing, and I kind of HELOC'd my condo, went all in, started house hacking, started joint venture and commercial properties. I got up to about 30 units by myself. I ran out of my own money, and then I started raising money from investors and expanding my portfolio from there until today, where I have about 240, 250 units or so.
Okay. Dude, that is an amazing journey on 3.5 years. Because if we were talking literally like in 2020, beginning of 2020, it would be a complete different story where we are today in 2024. So that is exciting. So one of the things that you mentioned that I want to make sure that the audience knows is, what is a HELOC? This is important because you said that was the one thing that helped you get started on that journey. HELOCs is one of the things that I always recommend people to use the equity that they have in their properties to be able to do more stuff. But I'm not going to explain it. I want you to explain it, please.
So HELOCs all come down to this concept of arbitrage, right? And this is how wealthy people stay wealthy. This is how private equity operates. This is how the rich of the rich operate. And they understand this crucial lesson. And it's the fact that if you borrow money at one rate, you can transition that money into another fund that provides you a higher return, right? Same concept with a HELOC. So more or less, it's a giant credit card on your property where you can access the equity you built up, right? And you can borrow that equity at a certain interest rate. During COVID, when I started, it was 3%. I believe now it's 7 to 10%. But in any event, you can borrow that money and can utilize that to buy other investments. So the key there is understanding arbitrage. Because if I'm borrowing at a 3 or a 4 back during COVID, or now a 7 to a 10, I have to make sure wherever I'm moving that money provides a higher return than what I'm borrowing at. And that's how I got started, is figuring out, all my net worth was in this line of credit, and I utilized that to really start buying multifamily at a higher return than what I was borrowing at.
Mm-hmm. Okay. And to get that, let's say people are interested about getting a HELOC. Who did you go to back in the day, or who would you go today to see, number one, if you can qualify for a HELOC and to get that qualification so that you can actually get the HELOC?
So back in the day, I just went to Citizens Bank. I didn't really know any better, and they offered me an 85% HELOC, up to 85% of the value I could grab, which amounted to around $200,000. Now I've also got HELOCs. I do a lot of HELOCs with small local credit unions and banks in my area, more or less portfolio lenders, where they hold the loan in-house. So that's primarily where I got a lot of my HELOCs. And for people who are thinking about doing a HELOC, they're incredibly powerful. But the thing you got to keep in mind is they are highly dependent on the appraisal of where your property appraises, right? And when it comes to HELOCs versus other sort of acquisitions, the appraiser doesn't have a number to go off of, right? With a new purchase, they know, like, you're trying to buy it for $550. I have to appraise it for $550. With a HELOC, the appraiser is simply valuing what they think it's worth. So it's incredibly important when you get a HELOC to give the appraiser rental property comps and give them comparables to show it's actually worth this amount, so you can get access to that amount at the appraisal, and that would transition to having a larger line of credit.
Yes, exactly. And so, for example, how did you use the HELOC the first couple of times? After you share yours, I'm going to share the power the power of the HELOC when I used mine. But I want you to share yours first.
It was a game changer. So the first time I used the HELOC was I used it combined with an FHA loan, right? A house hack. Everybody knows what a house hack is. You low down payment loan on a 3 to 4 unit property. So I went with an FHA loan, and I grabbed the down payment from my HELOC in the amount of $45,000. I was borrowing at, I think, a 3 or 4%. The house hack produced a 7-8% return. So I was making more money than what I was borrowing at that HELOC. Oh, and by the way, I got to live for free in one of the units, right? So Exactly. That's how I first started with my HELOC. From there, I still had about $155,000 left at that point. I took $65,000 from that HELOC, and I joined a syndication as a limited partner. The syndicator, the general partner, was offering a 15 to 20% return. Like I said, I was borrowing it at 3%. Simple concept of arbitrage. I moved my $65,000, where I was borrowing at 3%, into a fund that offered a 15 to 20% return. And that fund sold a year later for an 89% return.
Wow, that is amazing. And then the idea here is that you can take that money, that, for example, the money that you earn, and you pay off the HELOC. And then now you also have, because you can reuse that money, right? So you can pay the HELOC, and whatever's extra, you can use it for fun or for more investments, for all of that stuff. So
yeah, and you're exactly correct. And more or less, you're essentially getting in deals with none of your own money, right? It's essentially the bank's money. It's a very creative way to buy properties. And literally, I've transitioned this HELOC money into $500,000 of net worth by simply just moving money from one pot to another pot. Like, for example, that syndication I joined, that sold a year later for an 89% return. So I paid back my HELOC, and then I used that money on a fiveplex, right? Me and my buddy stabilized that fiveplex. We bought it for $650. We got it reappraised a year later for $905. We got a line of credit for all of our down payment. We took that money out, right? And now we used that money to buy a 9-unit. And we did the exact same thing. We bought it for $715. We put $200K into it. Now it's worth 1.4. We're refining our money out. So with that one move alone, and it wasn't even my own money, I literally created $500,000 of equity in these 3 properties.
That is amazing. That is amazing. And you'll see that as people do that, you get to see the increase in your net worth. You get to see the increase in those properties, and then you can capitalize on that. And because at that point, you're borrowing from the equity that you're creating to make you even more money. And that is the power of real estate, for sure.
So, I mean, the amazing thing about real estate is you can create value and money out of nothing just by putting sweat equity. And it doesn't take anything away from anybody, right? If you take a rundown property, right, you put money into, you make it nice, you get equity by putting in the sweat equity. And literally, it's not a zero-sum game. You're literally creating value out of nothing. So that's why I love real estate, is you can literally create wealth just with the use of your mind.
Yeah, no, that's amazing. So in 2014, 10 years ago, I bought my first house hack here in Austin.
Okay.
And I bought it for $170. That property, when I pulled the HELOC, I believe it was 2021 or something. It was, I was able to get a line of credit for $160,000, almost what I bought the property for.
Wow.
Back in the day, I lived for free. I bought it with 5% down, all that stuff. But I used part of that HELOC as the down payment for the condo that I have right now in Puerto Rico. So what's cool is that property that I bought 10 years ago was able to buy me the condo in Puerto Rico. Now, of course, I have to pay back that HELOC and all that stuff, but it's really cool that I didn't have to buy it from the money from my pocket. I just used the equity and bought my dream condo over there. So that is so cool.
So let me ask you this. I know you're a dreamer. How do HELOCs and how do loans work on your side? Do you have any issue applying for them, or do you have to jump through hoops to actually get approved?
Yeah. So that is a really good question. So as a dreamer, right, it means that I'm a DACA recipient, a dreamer. I am undocumented, but with the DACA program, I renew my driver's license and work permit every 2 years. It was a lot of hurdles. I couldn't get, I would hear no, especially here in Texas, it's a lot harder than other states to get a HELOC. And HELOC, for the audience here, is a home equity line of credit. So basically, it has to be on your home. You can do it also for rentals, and those are regular lines of credit. But for a HELOC per se, it took me a long time. And it wasn't until my buddy Alexis, who's also a dreamer, he was able to get a line of HELOC in California. And I was like, man, and he's a mentee, he's part of the mastermind. So I was like, if he can do it, there is no way. I have to figure out a way. So I was like, because he gave me that inspiration of being able to get it. So I contacted other lenders, banks, everything, and I found one commercial bank. So what I did is he told me the only way that we could do this is that we would have to be in first position. So first position lien. So he was able to get me that first position lien. We refinanced the property, and then he was able to give me on the second position the line of credit. And that's what made it awesome. So I had to talk to multiple banks, but it is possible. We just get a few more no's than regular Americans do, but you know my story. There's always a way. And I always say, if the door of opportunity is closed, go through the window. So that's one of those things that I didn't give up. And now I'm reaping the benefits because they were able to give me lines of credit of 2 properties. So now with the arbitrage game, it's really cool because I'm able to borrow right now at a 9%, but I can lend it out to other people too at 14%, for example. So I'm making that spread, and yeah, that's the benefit of it.
So you brought up a really good point. When it comes to lines of credit, banks tend to feel more comfortable when they have the first lien in place to get the second lien for the line of credit. And I experienced this as well. I remember I told you about that 5-unit property that I used with my HELOC money. Very exact same situation. The only bank that felt comfortable giving us a line of credit on this commercial property was the bank with the first lien, right? So I think you bring up a really good point, is if you are looking for a line of credit, reach out to your bank with the first lien. The good chance they might actually consider it because it's safer on their side. Yes.
And you have to ask them, how can we do this, right? Because they might say, oh, no, we don't do lines of credit. And they're like, okay, but how can we do it? Well, we can do it if we are first lien, because right now you don't have it with us. They might go to the bank and be like, can I get a line of credit? He's like, who's your lender? This person. Okay, no, we cannot do it. But that's what I was saying, is okay, how can I do it? And then they will find a way. But you have to have enough conversations to make that happen. That's for sure.
To your point, it sounds like you live by this motto, but I love hearing no's, because that's just a journey to a yes, And the most successful investors and the most successful entrepreneurs out there use no's as incentives to get the yes. And the least successful people out there hear a no and just stop. I guess I can't get that loan. I guess I can't buy that opportunity. There's always a way when there's a will.
Exactly. No, I agree 100%. Now, one of the cool parts about this conversation is that for people that want to scale their real estate portfolio, right? And you've done it in a huge way of, you were able to get to 30 units by yourself, right? Leveraging different things. One of the things that we always talk about is you can leverage your own equity, your own money, all that stuff to be able to get more properties. But you did something that you went on the next step, right? Which was raising private capital. And that is something that some people might be scared of doing it. They don't know how to talk to people or asking them about it. But you use raising private capital, you use that skill to be able to get you from that 30 units to 240. Now that you are, and we were just chatting how you were also seeing another 7-unit, and you show me your PFS too, and you're like, hey, this is everything that I have, but I'm missing a to on there to update it. But it's really cool to see how you've been able to scale. Tell us a little bit about how you've been able to to get people to trust you, to give you the money, raising private capital, and how have you used that to your advantage?
So before I touch upon that, I also want to mention this whole concept of arbitrage. There are other pockets of money that you can borrow other than your lines of credit, right? Think promissory notes. Somebody gives you a note for a set return, right? Say, for example, somebody gives you $50,000 and you offer them a 10% interest only until you pay it back, right? That's a way to get money. Or you maybe have an LLC that you have 2-3 years of tax returns with. You can go to a bank and get a business line of credit. I have an unsecured $50,000 business line of credit. You could borrow against your 401k. I have a $50,000 loan against my 401k, which I bought real estate with, right? So there are other ways to buy real estate by figuring out where your net worth is and figuring out ways to extract it via the line of credit sort of methodology, right? I want to touch upon that because that's how I got the 30 units. Like you said, I didn't once I read on my HELOC, I need to find money in other places, and that's where I ended up finding money. But to your point, taking the next step to raising private capital, it's daunting. It's absolutely daunting. And when you first start, it's extremely awkward to ask for money, right? But when you come from the mentality that you're presenting an opportunity to somebody, you're giving them a chance to make wealth, the conversation goes a lot easier. But to answer your question, it didn't come easy. And when I really started raising private capital is when I started going on podcasts, specifically the Bigger Pockets podcast, that really got my name out there and allowed me the confidence and the ability to raise that capital.
Yeah. Now, for the audience that wants to listen to that podcast, which episode was it?
I was on the Bigger Pockets podcast twice. Andrew Freed. I wish I knew the episode.
Right.
I do not.
They just put, okay, so you just have to look up BP, and then just type in Andrew Freed. Dude, when I was featured on the Bigger Pockets, like I always remember, I'm episode 352, and that being there changed my life because being there, that was when Brandon Turner was also one of the co-hosts.
Yep.
And between them and David Green, it was really cool to be there because I've always like admired that podcast and them and everything. So when I would feature on that one, after that, we had so many people reach out. And that is what got me started in building what we have now with like the mastermind, FI investors, everything. And it's really cool that by you sharing your story, right? There is power in sharing your story. You've been able to create that trust from people that then later they can trust you by you educating them hearing your story, and then you're able to buy more real estate properties. So that's awesome.
And I mean, and when it comes to raising private capital, it's honestly, it's quite a simple formula. You really have to really focus on creating likability and trust, right? And there are many ways to do that. Like for you host a mentorship. Like that's an easy way to create likability and trust among your mentors. I host a local real estate meetup. I've been doing it for 3 years. That's an easy way to build myself as a subject matter expert, build myself as a market expert in Worcester, Massachusetts. Oh, and by the way, people got to bring me deals and want to give me capital to invest in deals, right? Going on podcasts is a really easy way to build likability and trust. Rather than me having to, meet investor after investor to go grab coffee, they can listen to 5, 6, 7 hours of me on podcasts and feel like they know me without me having to commit the time. And it allows me to spread my grass that much farther, right? Those are some easy ways to really establish that credibility to raise capital. But I mean, at the end of the day, it all comes down to having a track record, right? Like I would never give that money to anybody who hasn't had success in that asset class. So thankfully for me, like I built a small portfolio and I showed that I was successful in this field before I started asking for money. And I highly recommend anybody else who does want to get into raising private capital, show proof of concept first before you kind of enter that realm.
Yes, proof of concept is really, really important. Now, you mentioned one thing that is interesting. So you created, like, I believe that everything starts by value first, right? Mm-hmm. So you said that you created a meetup, or you started going all into the local RIA meetups, right? The real estate in your area. And then that created trust from people. How did you get people to show up? How did you get people to join and all of that for somebody that's looking to being like, hey, there's no RIAs yet in my group, or there's no meetups, or maybe I want to start my own meetup. What would you recommend?
Consistency. We've been running the meetup for about 3 years. Yeah, I mean, the first 12 months were rough. You had low attendance. You just had to grind through it and establish yourself, as kind of the meetup in the area. And sooner or later, it would really kick in. But in regards to how to build a meetup, one easy way that I found building a meetup is like get high profile guests, right? Because a lot of times they come with an entourage, right? They come with a following, right? And then some of those people maybe trickle into your meetup and become regulars. Right? That's an easy way. Come up with a clear marketing plan, right? So normally when I do a meetup, I market it 2 weeks in advance, a week in advance, 3 days in advance, the day of, and I post on every single website I possibly can, Eventbrite, Meetup, Bigger Pockets, right? Oh, and by the way, I also go on all the local Facebook investor groups and I send out the meetup there. You'd be surprised how many people you get from simply just doing that alone, right? So those are some easy ways. And like I said, it all comes down to consistency. If you want to start a meetup and you want it to be successful, you have to commit now that you're going to at least do it for a year. Because if you quit after, if you don't get past that breaking point of 1 to 3, of like 10, 15 guests, and you just give up, like you probably left a lot of chips on the table, in my opinion.
Exactly. And is that consistency and it's time. And I really like what you said of doing it for a year. Because you have to be okay in the first 3 months, 4 months, you're going to suck. And it's okay, right? But you're building that credibility, you're building those connections, and that consistency does pay off. But you have to have that mindset, yes. Like you have to be committed for an extended period of time to get those results.
And I mean, meetups are fantastic for not only like creating value in the community, but also building your network. Like for meetups, at least for my meetups, I invite guest speakers. It's literally an excuse for me to invite the big players in my market and develop a relationship with them and network with them, right? Like I've developed so many deep relationships with big investors in my area that I could literally just reach out to them right now for any question. Do you have a plumber? You have an electrician? You have a lender? I get an answer instantaneously, primarily because I gave them the venue to be a guest speaker at my meetup.
Exactly. Yeah, and then depending on what you do afterwards, right? If you're there, you tag them on social media, they reshare it, their followers are following you as well now, and it just creates a loop of potential of you increasing your audience so that then they can go to the meetup the next time. So that is what's powerful.
And I mean, just going back to your original point, the key with anything really is provide as much value as you can and expect nothing in return, right? So when it comes to make it a free event, offer free food, like don't make it salesy, don't try to sell anything. I'm an investor focused agent. Like I don't sell the fact that I'm an agent at my meetup. I say I mention the fact that I'm an investor, right? Like just try to provide as much value as you can and the world will give back.
Yeah, no, I agree with that. Value first, really important. Now, you also have a newsletter, and at this point, I feel like you're hitting all the angles, right? Because you have your Instagram is great, and we'll ask you more about like how people can follow you and all that stuff later. But you also have your meetup, so it's in person, and you also have your newsletter for people that can be like out and about, not just necessarily in your area. And I've seen your newsletter and it is a long one. It is like thorough. You give a lot of value. Can you share like, and here's one thing too with consistency. I bet you that in the beginning, you probably didn't have many people in your newsletter. And then and it's been like years, not years, but like with time, maybe months or maybe years, you've been able to see more and more people and you've been able to get results. Can you share a little bit about your newsletter?
Absolutely. So the key with the newsletter is you got to have a comprehensive CRM, right? And you got to have a strategy for getting your contacts into your CRM or your relationship management system. And what me and my partner are really good at is we have electronic business cards on our phone. Whenever we go to an event, we always take everybody's information down and we plop them in the CRM. Right. So that's key is you want to fill the CRM up with as many people as you possibly can. And now when it comes to a newsletter, like you said, we just try to provide as much value as possible. So in this newsletter, we offer off-market properties. We have news articles on the real estate market. We have investor tips, podcasts. We go over all of our deals, deal by deal. Right. And we offer so much value in that newsletter that people can really get a taste of what our day-to-day life is, right? And it also acts as a investor relations tool because rather than me having to email every single investor every single month about their deal, they can just look at the newsletter. It's right there. It's completely transparent. We don't hide anything, right?
Yeah.
So the newsletter has been a game changer by far, and it's really kind of brought our capital raising to the next level. I mean, over the past 2 quarters, me and my partner have raised over $7-8 million.
That's amazing.
All through these strategies, and the newsletter has definitely been a game changer for sure.
Yeah, and with that, I mean, you're building that trust with other people, and you're hitting what some people would say, like people just want to put a deal out there and boom, they want to get $2 million that they raise, right? But like it takes work and it takes also some time and trust. And I feel like you've definitely created the right avenues for people to reach out whenever they're ready to invest with you and building that trust, because they can either meet you in person locally, you're giving them value, they're seeing you basically walk the talk, and then they're getting a lot of value with your newsletter. And I'll have to say this, whenever you shared everything about the newsletter and what you're doing, one of the members in the community actually now has his newsletter and everything, and he's doing flips in California, and it all came from you. So that's really cool. His name is Alejandro over there in Cali.
Awesome.
Yeah. So okay, so you've been able to build that. Now tell us a little bit, because you mentioned you have a partner too, and it's cool because you're hitting everything that we talk about, or like that I talk about with scaling your real estate portfolios, like partnerships. You have to look at the current equity that you have into your deals. You have to learn how to raise private money and all that stuff. So tell us a little bit about your partnerships and how you structure that with him.
So I have a partner on my investing arm, Zack Gray. We're 50-50 owners. He's very much boots in the ground. He's very much tenant communication. He's very much construction management. And me, I'm on the back end. I'm pretty much project management, deal with financing, deal with lending, capital raising. I more kind of handle the computer kind of components of our business, and he handles very much kind of the boots in the ground. So we make up a really good team where my weaknesses, his strengths offset my weaknesses and vice versa. So that really has allowed us to scale exponentially, because everything I don't like to do, I just hand off to him, vice versa. And now when it comes to raising for a deal or finding a deal, it all comes down to finding a good deal, right? At the end of the day, it comes down to finding a good deal. So that involves me and my partner submitting 50 plus offers a month and maybe getting one or two under contract, right? Yeah. Once we have it under contract, me and my partner front the due diligence money, right? Like we don't ask anybody to pay that besides our own to make sure it's actually a deal. Once we conclusion that it is a deal, at that point, we create a loan request package, get financing terms from our banks, and push that investment out to our investors via our relationship management system. Essentially, everybody who gets the newsletter will get our deals, right? And then at that point, we normally offer people an 8% preferred return. We set them up as a joint venture, so everybody in the deal normally is an active investor. And we offer the people bringing in money 8% preferred return, and then everything after that, all profit after the 8%, refinance money, cash flow, sales proceeds is split 50-50.
Okay, with the partners, and then then everything else gets split between the people that lend you the money and you as the GPs of the deal.
Me and my partner Zach, you're exactly correct. Yes.
Yeah, no, that's awesome, and it's really cool because I always talk about when you're finding partners, it's important to complement what I call like unfair advantages, right? And the unfair advantages is time, money, network, and expertise, like knowledge in the market and everything. And it's really cool that you've been able to leverage, like created that complement with your partner where he's the boots on the ground, he does all of that stuff, and then you're the one that's looking for deals and dealing more with like office stuff per se, like relationships, while the other guy is out there on the day-to-day in the property. It's really cool.
I'm very much he's very much working in the business, and I'm very working on the business. So it really allows us to grow, right? And it allows us to grow in a very safe way, because when we know, it's still being operated efficiently while we can actually enhance it.
Yeah, no, and that's great. And that's really cool. So what are, for people that want to scale, for example, too, we talked about partnerships, we talked about raising capital, equity. Are there other things that we may be missing, or are those three key things for people that like things that have helped you get to 240 units in 3.5 years?
You're missing the biggest component of all.
Which one is that?
Finding the deal.
Finding the deal.
You have all that in place, but if you don't have a deal, it doesn't matter. And finding the deal is incredibly important. And I've really separated myself from a lot of other people in the market in the fact that I've really gone on my way to create a brand presence, making it so people actually bring deals to me, right? So I have a large social media presence where I put out free multifamily tips and information on a normal basis. I host one of the largest real estate meetups in Worcester. I'm also an investor-focused agent. I got a team of agents under me, right? So like I've been on many podcasts, a lot of top podcasts, right? So all that combines for people knowing me in the market. So when they run across a really big deal that they can't take down themselves, who comes on the front of their mind? Andrew Fried, who's been on all their Facebook pages, who they listen to podcasts about, right? So that's been incredibly powerful, is using brand and social media to find deals. because it all comes with the deal. Like I can have all those other pieces in place, but if I don't have the deal, doesn't matter.
Exactly. Now, now let's say you found the deal, right? Mm-hmm. You found a deal, you've analyzed tons, you see one that, okay, this one works, potentially. So mm-hmm. Then you try to put it under contract. How do you go about doing the due diligence on that deal? Just break that down so that to the point that you do the due diligence and then you can get to say, okay, this is a deal that we can raise private money, that we will be able to pay back our investors, that you have the confidence that you'll be able to succeed with this deal. What does that process look like?
So contrary to normal belief, we do inspections for every single property we get under contract, right? So we get a formal inspection, and at that point, we bring all of our contractors with us, our carpenter, our electrician, our plumber, potentially a mason, if there's foundational work, right? We get a really good understanding of the scope. And combined with that, our team does the things in the back end to ensure that everything's in place with this property. We have a whole checklist of things like call the inspection office to ensure that the number of legal units are actually the number of legal units they are advising. Call the police department, see if there's been any reports. Call the fire department to see if there's any environmental issues with these properties, right? These are some things we do, get utility bills, call the tax assessor's office to understand, if this sells, will the tax rate stay the same? Will it go up 10%? Will it go up 20%? Reach out to your insurance carrier, get the numbers for the insurance, right? These are some of the things that we do to ensure our underwriting aligns with reality. Because at the end of the day, that's all we're really doing, right? We're just making sure that our assumptions are actually true. So that's kind of what we do is, we get a formal inspection, get all our contractors on there, do all that back end things. We try to get that done within 7 to 10 days. If everything aligns, we send out the lenders, we send it out to potential investors, and we start raising the money and closing on the deal.
Okay. And throughout that process, right, like the due diligence, all of that stuff, most of when people bring you deals, when you see deals, are they online, off market? What has worked best for you?
What has worked best is us, me and my partner, being very generous with the people that bring us deals, right? So we offer a finder's fee. We offer them potential equity in the deal if they're willing to get their hands dirty, right? So just being willing to be generous with people who bring you deals has been a game changer, right? And you're asking like, where do we find these deals? We find these deals all over the place, primarily through pocket listings, through brokers. I would say a lot of deals come that way, but they come in many different ways. Like we do some cold calling. We talk directly with some owners, some larger owners who own a lot of property, but primarily it's through our network. Okay,
no, that's awesome. And so we are halfway done with 2024. What does the rest of 2024 or maybe like the next 12 months look like for you, for your portfolio, all of that stuff?
So my ultimate goal is I would love to syndicate 10,000 units, actively own 500 units, help 10,000 people reach financial independence, and travel the world. So I have about 6 or 7 trips traveled. I'm going to Rome and a couple other places. I'm excited. I'm very excited about that. Me and my partner are aiming to get up to 300 units by the end of the year. We're at 240, so we still have to get about 60 or so more units. And then me and my mentor are starting a kind of a coaching program. So I'm hoping that will kind of, help with getting me towards helping more people reach financial independence. Because at the end of the day, it's like, I appreciate bigger pockets. I appreciate people like you that help me on my journey. So I give back.
Yeah, no, that's amazing. At the end of the day, that is one of the reasons why I do this too, right? And you're part of GoBundance as a member. I'm part of GoBundance as a member, and when they gave me the opportunity, when I wasn't a millionaire, it was like, holy crap, now, because like they didn't have to give me that opportunity. And as I grew, now this is my way to give back, right? To offer that to other people, to show them that what they taught me definitely works. And that's awesome that you want to give to others. So, and if there's anything that I can do to help in the future, definitely let me know. So
Invite me on your master. I'm always happy to provide value.
Yes, no, for sure. And you've been chatting to, you've come on the mastermind and everything. So that's awesome. So, Andrew, where can people learn more about you? Like, where can people be like, okay, I want to get that newsletter. I want to learn from you. I want to, maybe I want to invest with you. Where can people find you?
So they can actually find me on Instagram at Investor Freed, or on Facebook and LinkedIn at Andrew Freed. I'm always putting out posts. I'm always putting out educational information. On there, you can sign up for my newsletter on many of my posts. Definitely give my Bigger Pockets podcast a listen. If you like this type of content, like that podcast is packed full of how to utilize HELOCs, is packed full of how to the nitty gritty of investing in multifamily. So I highly recommend giving that podcast a listen as well.
Yeah, no, that is awesome. That is awesome. And one last question, because now that you mentioned the multifamily and all of that stuff, whenever you're finding deals, you told me that you just walked a 7 unit, right, this morning. But then earlier when we were chatting, you also mentioned that you have a 40 unit, right? So how have you created leverage for you, for example, to go from, hey, let me start with a 5 unit or 7 unit and then go all the way to 40. What are some things that maybe you learn on your way to getting those bigger deals?
I pretty much learned it's not that much more work buying a 7 unit than it is buying a 40 unit. Me and my partner, we primarily do invest in portfolios, meaning, maybe we buy 10 properties, and because we buy in bulk, just like when you go to BJ's, you buy something in bulk, you get a discount. That's the same expectation when we buy these portfolios, right? So I would say from the larger to the smaller, I would say, and enacting the stabilization plan, it takes longer with the bigger the projects you go. The smaller projects, you can stabilize quicker. So that's kind of been an area of learning for me, is kind of on the bigger stuff, I want to move 1 million miles an hour, and you can only move so quick on those types of properties without pissing everybody off. So
yeah, and I can feel that too with your energy and everything, which is contagious. So, but Andrew, dude, thank you very much for jumping on with us on the FI Investors podcast. Really appreciate your time always, and you always give so much knowledge. So that is something that is amazing, and I am really happy that we get to share this with you. So thank you very much for your time, and look forward to staying in touch.
Thanks, Diego.
Take care.
Thank you for listening to the FI Investors Podcast. Make sure you subscribe so you don't miss any future episodes. And share this with a fellow real estate investor who you think would find value in what we do. Until next time.